Let's start with this. Shell. It is the top holding in your Cohen Steers Natural Resources Active ETF. Last week, I did a fireside chat with their CEO, Wael Sawan, in Italy. He is very focused on putting Shell back on top. They are already the world's biggest trader of LNG. Why is this the biggest holding in your active ETF?
Yeah, we've spent the last few years thinking about what the future of energy markets are going to look like. And we've been thinking about it as this, hey, it's not really an energy transition. It's really going to be an energy addition story. For us, the future of energy demand, it's about population growth, it's about economic growth, and it's about the energy intensity of the global economy. And the reality is we need to produce as much energy from as many resources as we possibly can. So we start with, hey, we just need a lot more energy production from everywhere. And then it becomes around, well, what sort of energy do we think is going to be advantaged in the next few years? The last couple of years, it was all about alternatives. Alternatives are great, but they're intermittent and they're variable. And so they don't necessarily provide the predictability, the 24/7, 365 power needs that you need for data centers and AI and so forth. And so we've actually seen markets swing back the other direction towards more traditional forms of energy. And the reality is we think natural gas is really uniquely positioned, right? It is the lowest carbon intensity of the traditional power resources. There's a lot of it here. There's a lot of it around the world. We think natural gas is going to be a key solution for providing energy and electricity into these markets going forward. And we see a lot of value in European integrated energy companies relative to some of their North American counterparts. So it's part of the energy addition story. We think natural gas is a key bridge fuel into the future. And it's a place that we actually see some better relative value versus North American operators.
All right, well, we're going to switch to North America right now. So we're going to talk, but not the U.S. Let's talk about TC Energy, formerly known as TransCanada. It's a pipeline company. It's up 24% in a year. Second biggest holding in your mutual fund. Are the Canadian companies maybe not getting some of the same respect as their American counterparts? What is this?
Well, even though they're listed in Canada, they actually own a natural gas pipeline network across both the U.S. and Canada. And when we think about investing in energy infrastructure, it's a supply-demand game. What is the demand for pipelines? And then what's the ability to add new pipeline supply? And the last few years, really, the demand has been very strong. The ability to build new pipelines or add supply has been impaired. So if you can find markets where, hey, demand is actually growing and the ability to sort of grow new pipeline capacity is impaired, that's a place that you probably want to start to look from an investment perspective, because they're going to be able to generate above average returns, extend the duration of contracts, increase their investment opportunities, and so forth. The other thing with them in particular, when I talk about the energy addition, we're very, very bullish things like nuclear energy, right? Traditional resources like coal, oil, and natural gas, they produce energy when you want it, but unfortunately, they have an emissions profile that we don't really like. Alternatives, on the other hand, they have the right emissions profile, but they're intermittent and variable. Nuclear is the sort of one generation resource that can bridge both worlds. It is predictable, low cost, low variable cost, and it's a lot cleaner. And TC Energy actually has some nuclear facilities in Ontario that we think the market is underappreciating. So it's a real way to capture a lot of the themes that we've been talking about here. And again, we think energy infrastructure, natural gas, nuclear are going to continue to see very strong growth opportunities as the world recognizes the magnitude of the energy addition problem we have.
Listen, it's one reason we had their CEO on this show in-house a couple of months ago. Wrapping up with this one, it's another pipeline company, this one based in Tulsa, Oklahoma. Go Golden Flash. It's the top 5 holdings, or at least was, in your mutual fund. That is Williams Companies. Now, Williams, the yield is not as high as some other pipeline companies in the United States. So what makes this attractive enough to be in the top 5 of your holdings, Tyler?
Yeah, if you're willing to take the low yield, it's because you think that there's going to be better growth opportunities out there. So like TC Energy, they have a franchise natural gas pipeline footprint. For them, it's going to be about increasing pipeline capacity investments at very, very attractive returns. We've seen some announcements that are going to facilitate power and electricity into data centers for them. And we think there's going to be a lot more to come there. So in some places, you want higher yield, lower growth. In others, it's about, hey, I'm sacrificing some current yield for better long-term growth opportunities. And Williams is really an example of one that offers you quite a bit of growth, and importantly, growth that we think the market underappreciates.
Shell, TC Energy, Williams, ETFs, mutual funds, and it's the Golden Hurricane, not the Golden Flash. That's Kent State. My phone, in 10 seconds, Tyler, I had people texting me that I screwed up That's how immediate live TV is. Tyler Rosenlicht, Cohen and Steers, first guest on the new Power Play segment. Tyler, we appreciate it. Thank you very much.